We have Mr. Jyotivardhan Jaipuria, who's the founder and the MD at Valentis Advisors, joining us on the show. And let's talk about markets. Everyone's talking about markets. What exactly is happening? Do you think that this sort of a correction you can only pinpoint and only draw to conclusion that it is because of the disappointment on the earnings front that is actually leading to such a downtick in the markets? Or do you think there are a lot of moving parts that one need to watch out for?
Yeah, so I guess the starting point was valuations. So valuations have been expensive for some time. A lot of us have been expressing concerns about that. So, when valuations are expensive, you need one trigger. The earnings were little disappointing. That was one trigger. Then probably, the fact that China did a stimulus. You've seen some interest revive back in China. So to that extent, people are taking money off the table in some of the other countries which have done well. So probably, those would be the 2 points to really think about in this correction.
Uh, so 800 points is what we have seen a correction. The market's just 150 points away. Do you expect markets will stabilize anytime soon here on? And if yes, then what should be the key sectors that one should keep an eye out for if there is a recovery from here on?
Yeah, so like if you think about the market and the correction, so it's not been that major, it's not anything abnormal today. So if you look at the last 25 years, you tend to have like a 10% correction at least in 22 of those 25 years. So we are just about not even there on a 10% correction yet. So I would say this is like a very normal correction, which we see every year where 10% plus correction is probably the norm of the market rather than an exception. It's just that we've not seen it for quite some time. So when it comes, it obviously hurts people a lot. If you see the correction started last month, and the small caps actually did better in the last month than what the large caps did. Now in the last, probably 1 week, we're starting to see small caps do probably worse than the large cap, and that's where probably more people on the street are starting to feel the pinch of the correction.
Right. So, what's your view then? Do you think that looking at the way how the small cap is performing in the last 1 week, no doubt the call right now has been that you should shift out of these broader markets of small cap, mid cap players and look at large cap, quality large cap players. But when you look at quality large cap players, they've also been disappointing, isn't it?
Yeah, so like on a very short-term basis, yes, whenever the market's correct, you have more comfort in the large cap because one is relatively they're not perform as well as the small cap. So to that extent, people have comfort that at least they're not falling so much. Second is, relatively they're cheaper than where the small caps are today. In fact, the mid caps are today the most expensive space in the market. They trade at close to 28 times 1 year forward, which is, even by historic standards or relative to where large caps and small caps are, they trade expensive. So I would say on a very short-term basis, probably, the comfort will be more in the large cap than in the small cap. I would say from a 3 year point of view, I would still think, if we get a steep correction in the small cap and mid cap, that's where you should be looking at because of two reasons. One is earnings growth for the small and mid cap will be probably much better than the earnings growth for the large cap over the next 2, 3 years. And so that will drive, return for these people. Second is, in the correction, you'll start getting a lot of stuff cheaper. So keep a track out for, stuff which is looking cheap and where, the growth prospects are more visible because there are lots of pockets in the small cap where companies are small today, but they have a lot of growth visibility because, they have the order book or, they are in a position to get a lot of orders.
When it comes to banking stocks, yes, valuations are cheap and they have been cheap at least for the last 6 months that we have been seeing. But do you think that the worst is now over and one can at least start accumulating banking names right now? And if yes, in the BFSI space entirely, what would be your preference? Would it be the private banks, the PSU banks, NBFCs, or the capital market ancillaries?
Yeah, so if you look at the whole BFSI space, it's the capital market ancillaries which have done very well. So they've been, performing very well. The things which have not done well have been all the lenders. So the cheapness is in the lenders really. It's not in the capital marketplace because there the earnings are actually at a higher point in the cycle. So we've been nibbling at some of these lenders. In specific, we've been looking at some of the private sector banks which are trading at very low multiples, sub price to book of one, where just now the margins are compressed. It's like 6 months, 9 months later, the margins will start to improve. They'll normalize because government will start spending in the system, so deposit growth will start moving up because there'll be more liquidity in the system. That's where the NIMs will normalize. So for us at these valuations, it's like, heads I win and tails I don't lose type of situation, where if things improve, then returns can be quite high. And if things don't improve, then, with these sort of valuations, you've got quite a bit of downside comfort with you.
What about FMCG space or rather the entire consumption basket? Where are you finding some sort of a solace or a favor in at this point in time, given the fact that entire pack is actually getting hammered out of shape, also with the fact that the commentary has not been that enthusing. You were expecting some sort of a revival actually creep in for the consumption play, at least the FMCG play, but that's not how exactly it has transpired, right?
Yeah. So, we've been bearish on FMCG per se, which is the consumer staples space for like the last few years. And our thing has been a mix of three things. One is valuations are expensive over there. The second is, I think, the whole consumption basket, if we see consumer India, they are moving away from these staples to something else. It's getting more discretionary spend because as your income levels go up, people don't keep buying soaps and shampoos. They're basically, buying white goods. So if you see, on one hand, a lot of these FMCG consumer staple companies say demand is slow, but you'll see something like, white goods, TVs, you'll see mobile phones. There, the demand is not slow. There, the demand is strong. So for us also, that has been the shift in our portfolio. Like when we buy consumer, we typically don't buy the consumer staple names. We buy, more discretionary names. We buy things which are catering to white goods, catering to mobiles, could be ancillaries of companies catering to that. We buy, stuff which is catering to Indians wanting to spend more on holidays, on lifestyle. So, those are the pockets which continue to do well. So quite often there's a dichotomy because whenever we think of consumer spending, we end up thinking only of the staple space. The staples are struggling, but a lot of other parts of the consumer are doing very well.
And what's your view when it comes to Swiggy IPO? This was one of the most awaited IPOs. General market expectations post the muted subscription numbers that we had seen was that the IPO would open at a discount, but then here it's sitting at a premium of 13%, even in such a weak market. How are you looking at this food delivery and quick commerce space overall basis?
So, this space will do very well. So, it's a space which will keep getting market share from, the non-delivery space, and the space will do well. For us, it is, where the valuations are. We typically try to buy stuff which, we have a 3U's philosophy. We buy undervalued stocks which are underowned and underperforming. So for us, it's the valuations which have been a big constraint that at these valuations, the margin for safety is quite low on them. So even though the growth will come, you don't have that much margin of safety. So for us, we like to buy when companies are in pain in terms of the stock price. But otherwise, it's a space which, over the next 5 years, 10 years will do well. So far, there are few players. Whether the market shares change between them is something which will be up for grabs.
All right, then we leave it there. Mr. Jaipuria, thanks so much for joining us on ET
Thanks a
Now to
lot.
talk.